What could possibly be more important than Cinco de Mayo, the Kentucky Derby, Memorial Day, and Mother's Day in the month of May? It's the Dapper Dividends 3 cheap stocks to buy. What's up? My name is Russ, and here on Dapper Dividends, we talk dividend investing. And in this video, I have 3 undervalued, cheap dividend stocks for you to take a look at. With the first one being Embecta, ticker EMBC, which specializes in medical devices to help people who have diabetes, offering products such as needles, syringes, and other devices designed to make the process of managing diabetes easier and safer. Now, their products are sold through wholesalers and distributors to hospitals and stores, and Embecta's history goes back to 1924, but on April 1st, 2022, they became a standalone company separating from Becton Dickinson, ticker BD. Now, the CDC estimates that there are 415 million people worldwide who suffer from diabetes, and currently about 30 million, or just 7% of those people, use Embecta's products. Embecta's only been around since April of 2022, and they've made only 3 dividend payments in that short history, but they have a very low free cash flow payout ratio of only 6%. Now, at first glance, it looks like earnings, free cash, and sales have been declining, but keep in mind this is a company standing on its own, and as their parent said prior to the spinoff, they expect this to unlock value for Embecta. But I think what looks really solid is their 41% return on invested capital and 28% free cash flow margin. Their negative return on equity means their net income is lower than their shareholders' equity, and this is not uncommon for a spinoff, so we'll look to see if management can turn that around quickly. They do have about $1.6 billion of debt, which accounts for 80% of their liabilities, which exceed their assets. So there's a lot of people around the world that have diabetes, and unfortunately that number is growing. So Embecta thinks that the market for these products is worth more than $6 billion per year. They already sell to almost 30 million people in over 100 countries, and they want to expand even more by developing new technology and products like an insulin patch pump. So there's a pretty good opportunity for Embecta to grow, and it could be an interesting investment for somebody who wants to put their money into a company that's trying to help people manage this disease of diabetes. And alphaspread.com gives Embecta an intrinsic valuation of $37, making them about 26% undervalued. Next is a company that I've been buying for a little bit now, and it is Nexstar Media, ticker NXST, which is America's largest local broadcasting company with over 210 million viewers, and they own one radio station, which is 720 WGN. So every time you hear one of Nexstar Media's ads, this is how Nexstar makes their money, by selling those ads on their stations to local and national companies. And although they compete with other big media companies and digital platforms like Netflix, they focus on providing local news and content to their audiences. Nexstar has paid a growing dividend for 9 years. They have a 25% 5-year CAGR, and last raised that dividend 50%. And as of this recording, they have a yield that is 63% above their 5-year average. And the kicker is their free cash flow ratio is only expected to be 22% in the next 12 months, thanks to their strong free cash flow, which is projected to dip to $24.90 per share. So while analysts are predicting that their revenue is going to dip in the next 12 months, do keep in mind that 2024 is an election year, so that means we're going to have a lot of political ad spending, and that's only going to benefit Nexstar Media. But they still have an above average return on equity and return on invested capital, and have been slowly buying back shares. Do note that their net debt is a little bit high at 72%, but has slowly been trending down. So I think there's a lot of opportunity for growth with Nexstar Media, and CEO Perry Sook has big plans for Nexstar as they launched a new cable news network called News Nation in 2020, the CW, which Nexstar acquired in 2019 to target that younger demographic, and the really exciting ATSC 3.0. Nexstar expects this technology to become as important as the fees they earn from cable companies. And as we touched on, Nexstar faces competition from platforms like Netflix, and we know technology is constantly changing, shifting, and innovating, and the viewer with their eyeballs can change their preferences in a heartbeat. And I I have been buying Nexstar in the $155 to $185 range. And alphaspread.com gives Nexstar an intrinsic value of $276, making them almost 40% undervalued. And then we have Ares Capital, ticker ARCC, which is the largest business development company in the United States that provides debt and equity capital to small, highly leveraged companies that can't access traditional financing from banks. Ares Capital manages over $200 billion of assets. Now, most of us are investing in BDCs like Ares for the dividend, which they have been paying uninterrupted for 12 years, and they did cut that dividend during the last recession. But check it out, going back to 2004, Ares outperformed the S&P 500 by 63%. They're currently paying $1.92 per share per year, and as of this recording, that dividend yield is 20% above the 5-year average at almost 11%, and they have paid 7 special dividends since the second quarter of 2019. Ares Capital has a low payout ratio at 81%, and it is common for BDCs to increase shares to grow the business, which we can see their sales have been following the share issuance up and to the right. Listening to their earnings call, they talked about one of the potential drivers of growth would be that banks are tightening up their lending standards because they're seeing lower deposits. So this could be an opportunity for BDCs to step in with their cash from investors. But the flip side is that BDCs also do some borrowing themselves. So this will be interesting to watch play out as Ares looks for new loans to make. Now, if we have a severe recession, we would see a lot of loans fall into non-accrual, which means a loan is not generating interest income because the borrower's are not making payments. So we see here that Ares non-accruals are ticking up, but the amortized cost, which is simply the value of a loan on the books, is up to 2.3% of the total investment portfolio, and the fair value, which is what it is worth in the market, is only 1.3%. So while not a huge chunk of their portfolio, those numbers are still trending in the wrong direction. Alpha Spread gives Ares Capital an intrinsic value of $23, making them about 24% undervalued. And as of this recording, Ares is trading at a 3% discount to their net asset value, which is the total value of all the investments held by Ares minus any expenses or debts they owe divided by the total number of shares outstanding. Now, that number was $18.40. The new number is $18.45, so their net asset value actually ticked up. So I'm pleased as punch to be buying Ares Capital under $18.45, but even a little bit over for solid BDCs, sometimes it's good to pay up and pay that premium. So as of this recording, I've been buying Nexstar Media and Ares Capital, and I'm still debating taking a position in Embecta as a growth position that also happens to pay a small dividend. So if you were helped by this video, I'd love it if you give a thumbs up and also share your thoughts on these 3 stocks. Are you buying any of them? And also let us know what you are buying and what you have your eye on in the month of May. Now, do I look crazy to you? Well, I might be because of this Dividend King that I just sold and what I'm buying instead. Click the floating little box next to my head to find out what it is, and I will tell you all about it there.